Everyone's got an opinion on investing. Some swear by premium bonds, others bet big on crypto, and then you've got that one mate who only buys gold and talks about the end of the world. But what actually works and what's quietly draining your wealth? I've ranked them all and some of the results will surprise you. In this video, I'm rating the UK's most popular investment portfolios. We're talking about bonds, dividends, robo-advisors, index funds, and everything in between. Each one gets ranked from S tier to seriously why. I've used all of these myself and I've run the numbers, and I'll show you which ones help you build real wealth and which ones quietly bleed it away. Let's start at the bottom with a shiny one your nan probably still loves. It's a British favourite and it's premium bonds. You've either held them or your nan swears by them. They're safe as houses, she says, and she's right. Kind of. Premium bonds are issued by NSNI, that's National Savings and Investments, the UK's government-backed savings bank. You don't earn interest, instead your money goes into a monthly prize draw with tax-free winnings. You've got a chance to win £1 million. Sounds exciting, right? But as of June 2025, the average prize fund rate is 3.8%. That's if you're lucky. Many people aren't. There's a 1 in 22,000 chance per £1 bond each month, and nearly 2/3 of bondholders have never won a thing. I held premium bonds for 18 months and they were fun to open each month, I will admit that. But I ended up earning less than I would have had in a regular fixed rate savings account. I won every single month, but I had the maximum amount you could have in them, which is £50,000. I used it for a short term while waiting for a property purchase to go through. The big selling point is that the winnings are tax-free. That matters if you're a basic rate taxpayer because you only get £1,000 of tax-free savings interest before you start paying tax. Higher rate is only a £500 allowance, or additional rate gets zero tax-free. So if you're a high earner holding cash short-term, premium bonds can actually make sense. But here's the real cost. Inflation chips away at your money because even at 3.8%, you're likely still standing still. Meanwhile, a good fixed rate cash ISA pays around 4.5 to 4.8% today. And when you zoom out, over 20 years, £10,000 of premium bonds might become £21,500. But that same £10,000 in a global index fund at 7% is £38,700. That's £17,000 left on the table, all for a bit of monthly suspense. So who are premium bonds really for? If you need instant access to savings and you want a tax-free place to hold cash, or you enjoy a flutter that's backed by the government, but let's be honest, that isn't saving, it's a savings account dressed as a game show. So for this one, I'll put it in the C tier. It's safe and simple and it does have its use cases, but it's not for building serious wealth. Now, before we move on, I want to give a quick shout out to the sponsor of today's video, XTB, who've just launched one of the most interesting stocks and shares ISAs I've seen for a while. If you're fed up with paying high platform fees, fund fees, and trading fees, basically death by 1,000 fees, this will be right up your street. With XTB's new flexible ISA, you can invest in thousands of global stocks and ETFs, commission-free up to €100,000 in monthly volume. After that, it's just 0.2% per trade. There's no platform fee and no custody fee under €250,000, and you can start with as little as a tenner. So even if you feel like you're just dipping your toe in, you're covered. What I really like though is this: they actually pay 4.5% interest on any uninvested cash you hold in your ISA. So if you're waiting for the right time to invest, or you've just sold something and your money's still in your account, it's still earning while it sits there. It's also a flexible ISA, which means you can withdraw money and put it back in later without it affecting your £20,000 allowance. A really underrated feature if you're managing cash flow. So if you're looking to start investing or just want to cut costs and keep more of your returns, XTB's ISA is 100% worth checking out. I'll drop a link down below if you want to take a look. Now let's talk dividends, because let's be honest, checking your app every month hoping to win £25 isn't a strategy. So what do many investors turn to next? Dividends. A way to feel like your money is working harder, sending you income without you touching the principal. But is it actually a smarter play? So, dividend investing. Well, on paper, it sounds ideal. Get paid for holding stocks. It's passive income, right? You don't even have to touch your capital. And in the UK, this strategy has a huge following. People love seeing these payments drop into their account like your portfolio is paying you a salary. Dividend investing means buying shares in companies, often large established ones, that regularly pay part of their profits back to shareholders. You can take that as income or reinvest it. Simple. It feels productive and it feels safe. But here's where it gets interesting. The average UK equity income funds yield about 3.5 to 5.4% right now, comfortably above inflation. Some portfolios lean even higher, especially if you load up on FTSE giants. And there's a real psychological edge. Getting paid feels good. It's tangible and it's income that you can spend or reinvest with discipline. But if you dig deeper, dividends aren't guaranteed. Companies can cut them, especially in recessions, and UK dividend portfolios tend to be concentrated in a few sectors, like banks, oils, and utilities. It's not broad diversification, it's a bet on stability. And that's not all. Dividend tax can kick in once you pass your £500 annual allowance. For basic rate taxpayers, it's 8.75%, higher rate 33.75%, and additional rate 39.35%. So if you're outside of an ISA, that income can come with a real sting. Then there's a problem that no one talks about. It's something called opportunity cost. Some US-based growth funds pay minimal dividends, but they crush dividend funds in total return. Think less income now and more wealth later. That's because rather than paying out their profits to you as an investor, they heavily reinvest their money to grow the company faster. I mean, it makes sense, right? More money in the company can equal faster growth. Sometimes dividend companies can choose to pay out that money because they don't have a use for the cash. So where does it land? Well, dividend portfolios work if you want reliable income and you're emotionally soothed by regular payouts and you don't mind giving up some long-term growth. But for most long-term investors, chasing dividends can cost you more than it pays without knowing. It's frustrating as I love watching people build dividend portfolios and do it. And it looks really fun, but I have to remind myself that it's not the right way to build long-term wealth. Of course, that's in my opinion. Maybe something to revisit once you're ready to be retired as an option. So this goes into my B tier. It's great for peace of mind, not so great for growth or diversification. It's comforting and it feels productive, but if you're chasing financial freedom, feeling good and doing well aren't always the same thing. Which brings us to a different kind of promise, one where someone else does the work for you. You just set your risk level, hit go, and let the algorithm take it from there. I'm talking about managed funds and robo-advisors. Are they the modern investor's best friend or just an expensive autopilot? This is the do-it-for-me option. You hand your money over, answer a few questions, and the platform takes care of the rest. It sounds ideal, right? Set it, forget it, and go live your life. And to be fair, this approach has grown fast in the UK. Services like Wealthify, Nutmeg, Money Farm, and even big banks now offer algorithm-built portfolios, often filled with ETFs that rebalance over time. Now, at first glance, the fees seem reasonable. Wealthify, for example, charges about 0.6% total per year. That's a lot cheaper than traditional financial advisors who often take 1.5% or more. But let's break that down. On a £100,000 portfolio, 0.6% is £600 a year. Over 20 years, that's more than £12,000. And that's not including what you lose to compounding drag. And here's where the cracks start to show, because many of these portfolios include actively managed funds, which statistically underperform low-cost index trackers about 80 to 90% of the time. So you're paying for automation, but not necessarily optimization. And then there's the fine print. Some platforms can earn kickbacks or preferential deals on the funds they use. That means your portfolio isn't always chosen purely on your benefit. There's a business model behind the scenes. Now, these services are super convenient. You don't need to know what an ETF is or how to rebalance. You just need to log in, fund it, and chill. And for total beginners, that's super powerful. But once you learn about how to open a SIP or an ISA and buy a low-cost fund, you realize you can build a better version yourself, with fewer fees, better returns, and more control. So if you want simplicity and you're not ready to go DIY, robo-advisors can have a place. But if you're watching this channel, you'll probably be just about as ready as me to put them in the bin as I would. Let's put these in the C tier for convenient, maybe more crap. Because, to be honest, you can do better yourself with just a little bit more effort and save yourself an absolute fortune. The day a managed option consistently beats the market and justifies that extra cost, I will eat my words. Let's stay on the easy mode theme here, but look at a different option. Target retirement and life strategy funds. All in one portfolios, no platform fee, no algorithm, just set it and leave it. First, there's target retirement. These are funds designed around the year you want to retire, say 2050 or 2065, and they adjust automatically over time. When you're younger, they're heavy on stocks, and as you get closer to retirement, they shift into bonds and they become more conservative. It sounds smart, and in theory, it is. You don't have to rebalance or tweak anything. The guide path is built in. It's genuinely one of the few set and forget products that works for long-term investing. But there are a few catches. Most target retirement funds in the UK are built by providers like Vanguard, and their vision is solid, globally diversified, automatically adjusting, but still relatively expensive compared to DIY options. Vanguard's target funds carry an ongoing charge of around 0.24%, which doesn't sound like much, but if you're paying a platform fee, say 0.15% on top of that, it does add up. And unlike Life Strategy, target retirement funds gradually shift into more bonds over time. That's not a bad thing if you're risk adverse, but it does mean lower expected returns, especially in your final working decades when you still might want more growth. Let's say your pot grew to 500,000 right before you wanted to retire, and you were in one of these. Great, it may have gotten safer and it's returning you a 10% return, 50,000, but if the market's done 20%, you should have had 100,000 and you've essentially lost 50k. This is such a bad trap because you're weighing up between risking more because it's your portfolio's at its biggest point and losing out on the gains at this point. The general rule with investing is you should be riskier when you've got time to wait it out and more conservative when you don't have the time. I mean, really, that decision is up to you. There's also no customization. You can't tweak the glide path or dial up the risk or down, you're just stuck with their assumptions. If you want hands-off investing that's diversified globally, the idea of a fund automatically becoming safer over time appeals to you, then this works. But if you're still young and you're still building wealth and you want to stay aggressive for longer, there are better options. This one would sit in the B tier. It's easy, effective, and it works well for some, but its limited control and its more cautious glide path mean it's not the best fit for everyone. So next, Life Strategy. They're really popular funds and they have a similar vibe but a different engine under the hood. These are what I would call the Netflix of investing. You pick your fund, 20, 40, 60, 80 or 100% equities, and the fund does everything else. This works by giving you the numbers you chose in equities and the rest in bonds. The trouble is, however, what percent do you need of bonds and what percent do you need in stocks? Does anyone really know? Typically, and why I don't use them, is because the more percentage of bonds you choose, the worse your returns can actually get, but it is safer. But I would only want 100% of equities. Unless I was retired, then I would look to do something more like an 80-20 split or 60-40. Or I would just, like I say, be fully invested in equities. Now, there are some big selling points to the Vanguard Life strategy. They're diversified across the UK, US and Europe and emerging markets. They're automatically rebalanced, low cost, and it doesn't require a finance degree to understand. You invest and it just handles the rest. But here's the catch, because it's not truly global. Vanguard gives these funds a heavy UK bias of around 20 to 25%. To put that into context, the UK makes up around 4% of the global stock market. So you're getting 5 times more UK exposure than the world actually has, which doesn't seem quite right. Now, for some investors, that home bias is actually comforting. For others, especially younger ones chasing growth, it is a drag, and you also can't tweak them. You want 70% equities? Well, too bad. If you want to dial down the UK exposure, no. They're preset bundles, which is great for simplicity, but not for control. But honestly, they still work. The fees are around 0.22%, and when you compare them to actively managed portfolios or DIY investing gone wrong, they're often better. So who are they for? Well, they're great for beginner investors, people that don't want to stress over asset allocation, and those building long-term wealth without obsessing over charts. You won't become the next Warren Buffett holding one, but you also won't accidentally YOLO into random stocks at 2 a.m. in the morning. And that, for most people, is a win. So again, B tier. Not perfect, but a rock-solid, beginner-friendly foundation. And while Life Strategy is built on logic and diversification, what happens when logic goes out the window and we invest based on a meme or what we've been told down the pub? Okay, before all the crypto bros hunt me down, yes, some people made life-changing money. Yes, it's decentralized, and yes, the technology behind it may or may not change the world. But let's separate blockchain innovation from your mate putting his life savings into Dogecoin because Elon tweeted about it. Because here's the brutal truth. Crypto is not investing, and it doesn't produce income, and it doesn't grow earnings. It has no intrinsic value. The price is just whatever the next guy is willing to pay. And in that sense, it's less like buying a business and more like trading Pokemon cards with better marketing. In fact, you're probably more likely to make money trading Pokemon cards. Now, could Bitcoin become digital gold? Maybe. Could Ethereum power a new financial system? Possibly, but you need to have bought it and sold it at the right time. As much as the idea of buying it for a tenner and selling it for 100,000 sounds amazing, most of us would have sold it once it reached £100 and we 10 times our money. The idea of Bitcoin going up in price continually sounds great in theory, but that's just speculation and it's not investing. And if you treat speculation like investing, you'll either be in the tiny minority who made a lot of money out of it, or more likely the 99% who didn't make a fortune and you'd be wishing you chose something more reliable. Even if you pick the right coins early, the drawdowns are brutal. Bitcoin dropped over 80% multiple times, entire platforms have vanished, there's been scams, rug pulls, and hacks are baked into the space. And yet, every cycle brings a fresh wave of hope. Because nothing hits harder than the FOMO of someone turning £500 into 50,000, while you're earning 4% in an ISA. But if you do want to buy some crypto, you just need to treat it like Vegas money. It needs to be money you're happy to lose, not money you're banking on for your retirement. There's nothing wrong with buying some crypto as a speculative investment, in fact I do it myself, or holding some of the biggest coins in a safe platform to see what happens. But relying on it for your long-term investment strategy is pretty crazy. So for that reason, from a purely investing point of view, it's D tier. So D tier. Fun, sure, but not where serious money lives. It's fun to watch, maybe fun to play with, but it's not a foundation for financial freedom. Now, one growing reason people turn to crypto is as a hedge, a backup plan, a bet against government fiat currencies and financial systems. And I'm getting asked this more and more. But here's the thing, people are making the same bet for thousands of years. Which brings us onto our next one, the original end-of-the-world asset, gold. Gold gets romanticized. It's an old school safe haven, the asset people think will protect them from inflation, market crashes, and even total societal collapse. It's often praised for having a negative correlation with stocks and a positive correlation with inflation, making it sound like the ultimate portfolio stabilizer. But here's the catch. Gold isn't productive, it doesn't generate income, and it doesn't grow businesses. You just hope someone will pay more for it in the future. As Warren Buffett put it, you can fondle with gold, but it will not respond. Let's break it down. From 1988 to 2019, gold returned 3.43% per year. Global stocks over the same period, 7.85%. And gold was actually more volatile than those stocks. In 2008, when markets crashed, gold was up 5.5%. US government bonds up nearly 14%. Not exactly the golden parachute it was sold as. And while people talk about gold protecting you from inflation, the data is quite fuzzy. It might work over centuries, like since the days of the Roman Empire, but in real investing timeframes, it's hit and miss. Even in extreme cases like Brazil's hyperinflation, gold lost around 70% of its purchasing power in real terms. It did better than cash, but it doesn't make it a great hedge. It's just a less terrible option. Plus, it costs you money to store. It doesn't pay you anything while you hold it. And in the real end-of-the-world scenario, well, good luck swapping it for food at Tesco. Gold can offer a small diversification benefit, but from a return standpoint, it's lagging behind. There are better safe havens like government bonds that provide protection and returns. Okay, it might not protect you from the government themselves, but you see what I mean. So this lands in my C tier. It's shiny, it's dramatic, but as an investment, it's more myth than magic. Next up, let's talk about something that feels like investing, but it might actually be riskier than gold. Buying stocks. Now, on paper, stock picking sounds exciting. You're backing companies that you believe in, you're the next Warren Buffett. Maybe it's your employer's shares, maybe a company you know inside and out, but here's a reality check. When you pick individual stocks, you're exposing yourself to idiosyncratic risk. That's fancy talk for something random that tanks your stock. And the stats, brutal. 44% of US stocks from 1980 to 2020 fell more than 70% and never recovered. Over half of all individual stocks underperform the market, and just 10% of them drive most of the market's long-term return. So yeah, you might pick a winner, but statistically, you're more likely to pick a long-term loser. And get this, even if you chase recent winners, data shows that these stocks often underperform over the next decade. So past performance really isn't a predictor, it's more like a trap. Some argue that holding 20 to 30 stocks is enough diversification, but newer research states that you need around 250 plus stocks to meaningfully reduce risk and tighten long-term outcomes. That's not stock picking, that's just an index fund. And good luck staying on top of all of those companies. So why do people still do it? Well, you've got overconfidence, familiarity bias, FOMO, and let's be honest, it's kind of fun, but the odds are stacked against you. You're basically rolling the dice for outperformance and accepting huge chance of underperformance or catastrophic losses in return. And trust me, unless you want to wake up at 6 a.m. every day and read market news and boring company reports, you do not want to be a stock trader. Sure, you can buy some of your favorite stocks for fun, but it shouldn't be a foundation of your portfolio. My own stock holdings make up around 4% of my portfolio, so I'm putting this sadly in the D tier. It's high risk, there's a low probability of success, and most people don't even realize how dangerous it is until it's too late and you've wasted years of your life. Now, instead of worrying about buying them, you could buy the most popular companies, but in a different way. Let's talk about what happens when you bundle hundreds of companies and winners together. I mean, if picking one company is a gamble, why not just own 500 of the biggest ones? Let's talk about the S&P 500. This index tracks the largest publicly traded companies in the US, being Apple, Microsoft, Amazon, Google, Meta, and Tesla, and the rest of the heavyweights. And there's a reason why people love it. It's insanely simple. You've got one fund, 500 companies, and it's massively diversified within the US. It's got ridiculous long-term returns, around 10% annual since inception. It's cheap to invest in, with some funds charging less than 0.1%. And unlike crypto or stock picking, the S&P 500 actually has data behind it. It's not about catching the next rocket, it's about riding the proven engine of capitalism. If you'd have bought the S&P 500 for the last 30 years, you would have weathered the dot-com crashes, 2008 COVID, and still come out miles ahead of most active investors. Now, a quick reality check, it is all US companies, there's no emerging markets, no Europe, no Asia, and that's fine if you're bullish on America, and as history says, that has worked well. But if you're still putting all of your eggs into one country's economic basket, one benefit is that these companies do trade globally, but are still massively affected by America. This one is good for long-term investors and people chasing growth, people who want simplicity with serious firepower, and anyone who doesn't want to gamble on a few companies, but still wants to grow their wealth. This one I would give A tier. It's powerful, it's proven, and it's easy to access. And if you told me your entire portfolio was in an S&P 500 tracker, I wouldn't hate it. But what if you wanted that same potential growth and a bit more global balance? Before we go full world domination, there's one more solid stepping stone, which is developed world index funds. These funds track markets in places like the US, UK, Europe, Japan, Canada, and Australia. Basically, rich, stable countries with established economies and a really good governance. And honestly, they're a fantastic step up from just US-only exposure, because you're still getting huge exposure to the US, usually 60 to 70%, plus companies in other major economies. And you do stay away from riskier emerging markets, and it's more diversified than the S&P 500, but not as broad as full global funds, because it skips out on places like China, India, Brazil, or any developing economies. And that's both the pro and the con. You avoid the political risk, currency swings, and volatility of emerging markets, and you also miss out on their explosive growth potential. This provides more global risk, but helps you stick to what can be safer markets. Or maybe you don't want to overcomplicate things and you want to avoid small cap stocks. The fees are low and the volatility is decent, and the performance has been solid long term. Not quite as flashy as the US only, but more balanced. So I would give these an A tier. Now they could be made an S tier if you added in some emerging markets like I do with my 2 world fund strategy. I will link that at the end of the video for you. But if you just wanted one, this developed world is a great option. I have to put them neck and neck with the S&P 500 because this one has more diversity and the S&P 500 has average higher returns. Both of these options are far safer than stock picking, and for many UK investors, it's a sweet spot between growth and peace of mind. But if you're looking for maximum diversification, global balance, and zero compromise, there's only one place to go next: the FTSE All World and the Global All Cap. These are the S tier for a reason. If developed world funds give you major economies, then this one, it gives you everything. Let's talk about the FTSE All World and Global All Cap. Now, these are again in the S tier. These funds offer you true global exposure, so you're not just investing in just US, UK, or Europe, you're also getting access to Japan, Australia, and emerging markets like China, India, Brazil, and depending on which fund you choose, thousands of mid and small cap companies too. Now here's where it gets interesting. The FTSE All World is a more popular choice because it's easy to access and it covers large and mid-sized companies across both developed and emerging markets. It has around 4,000 stocks in total. The Global All Cap goes one step further and includes small cap stocks as well, expanding the reach to over 7,000 companies globally, so it's even more diversified, though slightly harder to find on UK platforms. Now the trade-off is fees. The All All World Index typically charges around 0.22% or less, and Vanguard's Global All Cap is a little bit pricier at around 0.23%. It's not a huge difference, and you can actually get the FTSE World for around 0.15% by choosing a different provider, but even 0.23% is incredibly cheap for the amount of global exposure you are getting. This is what owning the market actually looks like. You don't have to pick winners, you don't have to time the market or know which region's going to do well. You just hold everything, and as the world grows, so does your money. Historically, global equities have delivered 6 to 8% annualized returns in the long term. That's through recessions, wars, crashes, bubbles, the lot. But beyond the numbers, the real win is psychological. You're not betting on any single market, you're not panicking about the performance in one country, you're globally balanced, broadly diversified, and emotionally neutral. This kind of fund is ideal for long-term investors who want growth, simplicity, and peace of mind without trying to outsmart the market. For me, this is the ultimate default. If you only picked one fund to build long-term wealth, this would be it. It's S tier because it's clean, global, and uncompromising. And for most investors, it's all they'll ever need. So there you have it, 11 different ways people try to grow their money, from premium bonds to gold to global index funds and crypto, and some of them feel safe, some of them feel exciting, but very few actually deliver the long-term consistent growth people think they're getting. The truth is, the more complicated you make your portfolio, the more likely you are to mess it up. And the more you chase the edge in stock picks and dividends and the speculation, the more you risk underperforming something as boring and brilliant as a global diversified index fund. There's no shame in simplicity. In fact, it's usually where the best outcomes come from. If you really want a mix, go for it, but do it with purpose. So whether you're just starting or you've been investing for years, the takeaway is the same. Know why you're holding what you hold. Question whether it's actually helping you build wealth or just making you feel clever. And never forget that boring stuff, that's what actually works. And if still holding premium bonds because your nan told you to, maybe send her this way too. If you want to make sure you're using the right type of account, I'd recommend to check out these videos right here. I compare all of the top ISAs on the market, and on this one, I will even go deep into my 2-fund strategy and tell you exactly what I buy. Thanks for watching, and I'll see you in the next one.